This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Luke's picture saying, looking for the downloads. Now, Eric, let's start by covering crude oil and the EIA inventory.
It was a week of builds, Patrick, with crude oil printing a 3.2 million barrel build, Cushing, Oklahoma building 2.1 million barrels, gasoline building 1.3 million barrels, distillates was the only drawdown on the board, drawing down 1.2 million barrels for a net petroleum build of 3.3 million barrels. U.S. production held steady at 13.1 million barrels, unchanged, and that's after plateauing at 13.3 million barrels, which is also the same level it plateaued at before the pandemic began. Prices are holding over $80, the round number resistance level, as well as the short-term moving averages, despite the inventory builds. But they're still taking their time in terms of the rally not really having a whole lot of juice behind it, and that's consistent with the view that the market is tightening slowly, but plenty of spare capacity in the Arab states prevents a really big rally from taking off from here.
While oil's been relatively range-bound for the last week or two, when we look at this chart on page 2, we can see that it's clearly been accumulated over the first quarter of the year. Higher highs, higher lows, sustained price action above 50-day. And while there is spare capacity and all sorts of things that suggest that oil doesn't have a huge upside, I also think that there's a lot of people positioned on the wrong side of this trade, which could create a short-term short squeeze. I think at minimum we could see $85 on the upside, but if the short squeeze happens, we could see the 90 handle on crude. I don't think that's going to be sustainable up there, but it will fit the narrative of that trade range that Luke alluded to in the interview. We get up to 90 and then trade back down to 70. And I think that right now in the short term, with at least the way the price action continues, I think higher for oil here makes a whole lot of sense. So let's move on to equities. I want to get Nick involved in the conversation. Nick, what levels are you watching on the S&P?
Yeah, Patrick. So right now the spot price on SPX is approximately 52.50. We have an implied move for the April 19th monthly OPEX of 110 points. Therefore, the upper implied move is 53.60 and the lower implied move is 51.40. Right now, I'm inclined to think we see a bit of a holding pattern until the April OPEX. Key resistance is currently at 52.50 with key support at 5200. And I think we kind of sit in this narrow range over the next couple of weeks until that OPEX passes by.
On page 4, Nick, I have the S&P 500 chart with the 50-day moving average, but really I should have even put the 20-day moving average on there because what's amazing is that this rally's been so relentless that it hasn't violated the 20-day moving average once on any sustained basis since the November breakout. And it just really shows that the bulls remain in control. Higher highs, higher lows, price action in that favor. The next measured move, if they can break this to a fresh high, the measured move is up to 5,400. I personally think that the fact that we got up to this level without the rally being checked, it's a big surprise to me, but it doesn't change my bigger view, which is that while the bulls remain in control of the price action and the trend is definitely your friend, I still believe the upside is marginal at this moment before some sort of corrective pattern comes in. And because of the level of complacency and the amount of people that had to buy into this rally, I think from a reflexive perspective, a correction of at least 500 S&P points is going to inevitably come. But the fact is we've been waiting for some sort of technical trigger to show that a sell cycle has begun. And we're almost finished the first quarter of the year and not one has appeared. It'll be really interesting to see what happens in those first few weeks of April. And nonetheless, let's move on to the NASDAQ. What are you watching on the Qs?
So right now, a spot price on Qs is approximately 445. We have an implied move of 13 points for the April monthly OPEX. And right now, the upper implied move is 458, and the lower implied move is 432. We have key resistance right now at 450 and key support at 430. Again, as I said in past weeks, I'm not so bullish on tech right now. I'm more so bullish on the small caps, and I'm selectively bullish on certain names in big tech right now, namely Apple and Google. Otherwise, I'm pretty much waiting, again, in a holding pattern until the monthly OPEX passes by, and thereafter we have the FOMC, which should cause some volatility.
What's interesting, Nick, with your idea of the April OPEX is it also will line up with the pig in the python moment of the earnings releases and the earnings guidance being given. It'll be interesting to see whether that becomes the next inflection point as we move forward. Nonetheless, let's touch on the VIX chart on page 6, but there isn't much to say here, Nick. Ultimately, the market has been rallying. Things are relatively calm and complacent, and the VIX has gotten down to a 12 handle, and that's right down to the 3-month lows, and things are pretty calm here. What levels are you watching here?
Yeah, so with the VIX at around a 12 handle, we can expect intraday top to bottom moves of about 0.75%. Not really much has changed in the last week or so. We're seeing a lot of complacency overall. And as you mentioned previously, if we do get that pullback eventually of about 500 points on SPX, that would mark about a 10% movement to the downside, which we saw actually last year. So keep in mind, last year in 2023, we saw 2 10% pullbacks, even when we finished the year up plus 26% or so. So it can easily happen where we pull back down to, 4,800 from the current level, and the VIX would spike up to around, 17, 18 handle perhaps. But right now, no indication at all. I think being selective in your approach as to how you ensure your portfolio as to, expiration date wise on your purchasing of puts, as well as the strategy you're using, put spreads versus straight puts, for example, is very, very important. But right now, insurance is very, very cheap. And it would be wise to perhaps either take some off the table if you're overly long or if you want to hedge your portfolio overall. Now, moving on to page 7, we have the U.S. Dollar Index. Eric, what are your thoughts here?
Well, we had 2 consecutive closes over 104 on the Dixie on Tuesday and Wednesday. If that was it and it stops here, okay, fine. This is a logical place for a top. It's where the last cyclical top was if we're just in a consolidation pattern. But if we get a daily close over 104.5 or a little higher than that, whatever the previous high was from a month or so ago, that would suggest that we might be starting a new leg even higher. So is this a sideways consolidation or are we starting a leg higher? That's really the question to ask, and the answer, at least a clue to it, should come from whether or not we get a daily close over 104.5 in coming days.
Eric, I actually think that this dollar strength is something that can't be ignored. The euro is breaking down below 108. You have a yen that is right along the U.S. dollar yen that's up along the 152 level. And if all we need is a little push off the cliff and we've got ourselves a U.S. dollar bull trend, this, in my mind, it has all of the makings of a short-term breakout. And not many people are talking about this. Now, does that mean that there's a big extraordinary run where we're going to see 110 or 114 on the dollar index? No, or at least too early to speculate. But at this stage, if we see this continue, there's no reason why we ain't retesting the October highs near 107 on the upside. And I think that this is the chart to watch.
And moving on to page 8, we have that gold futures chart, which is making new highs. What are your thoughts here?
Gold is performing incredibly well. It's holding up and just printed a new all-time high close on Wednesday, and that's despite the strengthening U.S. dollar. That strength, despite dollar strength, portends more strength to come. I think we are headed at least to 2,300. That's probably a good place for the market to take a breather and retrace a little bit, but ultimately I think we're probably headed higher than that. 27.25 is the target for the long-term cup and handle pattern. I don't know if that's going to happen this year, but I think that by the time we get to the election in November, we're going to be higher than just 2,300. Let's see what the market gives us.
Eric, I have to agree with you. The fact that the U.S. dollar is strong and looking like it's breaking out and gold just continues higher, there has to be something to that. I mean, the targets from last week when you and Ole Hansen were talking about 2,300 are still very much in play. I'm a little bit surprised at the strength, but at this moment, there's no reason not to remain bigger picture bullish. The bigger question in my mind is this the breakout that sees those really big bull impulses that could see 2,700 plus, or is this simply just a quick move and then we're going to spend many months consolidating once we hit the upper boundary of a short-term range? Nonetheless, the pattern of higher highs, higher lows and is still in place, and the bulls are in control, so we have to play that way. I wanted to, though, move on to page 9, where I just wanted to touch on the silver chart, but what I did here is I put the weekly chart so I could capture at least 5 years of price action. And while gold has been trading at an all-time high, silver has yet to join the party. And so at this moment, we're going to watch closely whether or not this can actually bullishly follow through. I think silver, while it's not an asset that is actively accumulated by central banks, inevitably, as gold is moving and retail interest starts to pick up, you would think that it would start to reflect in the supply demand of silver and drive it potentially back towards $27, $28 highs that we saw a few years ago.
And on our last page here on page 10, we have the chart of uranium. Eric, I'm always interested in your thoughts.
Most of the uranium mining charts suggest that the bottom is probably already in, but the recovery off that bottom has been sluggish at best. When something really is a bottom, the market doesn't usually give you multiple chances to buy it at that level, which we did get this time. That tells me that there's still room for another leg lower, although we're not seeing it in the charts quite yet. Maybe that's just wishful thinking on my part, because I was hoping for that leg lower to buy more shares, because I'm still uber bullish long term. I think the spot market and the term market are disconnected in a way that's confusing a lot of people. Justin Hune over at UraniumInsider.com has done a lot of analysis on that. We're working on getting Justin back in coming weeks here on MacroVoices.
Eric, I generally look at it the same way you do. To me, and when I look at this chart of the Sprott Physical Uranium Trust, to me, it needs a legitimate breakout north of $30 to demonstrate that the bulls are actually putting together a new bull sequence and it's off to the races again. The fact that we've bounced and it's just consolidating along its 50-day moving average, to me, leaves the window open, like you're suggesting, that there could be still, one more dip. But overall, even if the Sprott Physical did dip one more time, let's say a quick drop to $25, I still believe it's a compelling buying opportunity. After a 9+ month run, expecting a 2 to 3 month market correction that gives back half of its gains is a very typical type of price action move. And so this doesn't change the bigger bullish picture. It's simply about just trying to size up what is clearly a mean reverting profit taking correction. How deep does it go, and where does the next bull trend really begin?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.